Hello everybody, this is Charles Pedroso of the Pedroso team, Coldwell Banker Residential Brokerage in White Plains, New York. This is our third installment videos in which we run through many homes or real life examples currently listed for sale in our Westchester County market. And we show prospective home buyers, especially first-time home buyers, how they can create a foundation for wealth for themselves, or really financial independence, I think is the most accurate term, right? So this home is in Lower Westchester. It's a three-family home. It has 3 units. Each unit has 3 bedrooms and 1 bath. Every unit appears to be renovated in the conditions shown in the photo at the far end. And here's the exterior of the home. It's a freestanding building, detached, not a very large property lot, but that ultimately allows one for lower property taxes in owning this home in what appears to be a very densely populated area in Lower Westchester County. So I just want to run through the math with you, and that really displays the opportunity, or gives us an opportunity to really convey this opportunity to a prospective buyer. So assuming you made a full price offer on this home, and rather than negotiate a percentage of the purchase price in total price, which is really money in most cases that you're financing over the course of, say, 30 years on a fixed rate mortgage, which would be our suggestion, one could ultimately make a 3% down payment to own the home and negotiate 3% back from the total purchase price to be used at closing to offset most of the closing cost expense associated with the home. So in this scenario, if one purchased the home at $450,000 and you put down 3%, which is $13,500, you could, as I said, get that $13,500 back at closing from the total sales price to use to offset your costs, which would leave you with an approximate balance of anywhere approximately between $3,000 and as much as $6,500 additional. So what we're saying here is that the total out-of-pocket outlay to own this home, all in, accounting for a year's worth of homeowner's insurance premium, which you pay up front, some attorney's fees, some title insurance costs, and other recording charges associated with purchasing a home in New York and Westchester County and this specific city, your total outlay would be approximately $20,000. So for $20,000, you can buy this $450,000 house with 3 units, each having 3 bedrooms and 1 bath. The rental income for units of this size and this condition in this community ranges anywhere from $1,900 to as much as $2,200. For the purpose of this example, I'm going to use the low end, so not to overstate the opportunity, and what I'd like to do is really show you what appears to be the sort of worst case scenario for a prospective homeowner for this home. So currently the units are occupied, so you'd be moving into a situation in which the rent rolls are coming in. There appears to be a lease on these units, and with rent rolls increasing, there's always the opportunity to move on to a new tenant if you so choose, should you become the owner of this property. But to walk you through the math, as we said, it's $20,000 out of pocket. If we're getting, as I said, on the low end, $1,900 per month for each unit, if you were to move into one of those units, you would receive $3,800 per month. Now, just to walk you through the math of the expense for this home, having put down only 3%, which is $13,500, accounting for the property taxes, which turn out to be exactly $13,500, and an estimated homeowner's insurance of about $1,650, which is about the going rate for a 3-family home of this size in this community with this estimated value. So that equates to, at 97% of purchase price, a loan of $436,500, which, remember, accounts for or includes $13,500 of which you'll be using to offset your closing costs. So that gives you a principal, interest, that's the mortgage, taxes, and insurance payment of $3,346, approximately. Let's call it $3,350. If we know the 2 other units in this home are bringing in $3,800, that tells you immediately that you have about $450, or to be exact, $454 positive cash flow after having paid your principal, interest, taxes, and insurance, and you get to live in one of those units that has 3 bedrooms and 1 bath. That leaves you with a positive cash flow right from the beginning, so that should you move from this home, and when that time comes, should you look to buy another property, and assuming rent rolls are exactly where they are today, they don't go up or down, which they very well could, but in most cases we know they tend to go up or climb steadily over time, one could increase their total cash flow to about $2,355. That means that you could have, after you've lived in the home for at least a year and having rented out that last unit, a positive cash flow of $2,354. That's amazing. Even to live in the home and know that the rent rolls are paying over and above what the principal, interest, taxes, and insurance payments is, it's a phenomenal opportunity. So for any first-time home buyer, if you thought maybe you couldn't afford to live in a home, or you thought maybe the housing expense associated with the mortgage is maybe too high, but you've been a tenant before and you know what it's like to have interactions with the landlord, why not become one yourself? Why not create this, as I said, financial independence for yourself in the near term and over time, while you have this asset which generally appreciates, as we know historically, creating, as I always like to say, the foundation or a option to create a foundation for wealth, right? So here's one example or another example. We're going to continue this series moving up in total purchase price, rent rolls, and associated housing expenses, because that's what's relative to properties as you move up. But we'll see over time that there's so many opportunities throughout so many different communities in this county for a first-time home buyer to really establish themselves financially and create additional income and security and the freedom that comes with ultimately not having to lay out of pocket net dollars that are really a liability. You know, in the end, if you're getting this income and you have the liability and it's offset, it allows you to save more of what you make, or maybe take some, an opportunity to become self-employed, maybe pursue further education. Maybe you just don't want to work at all in that 9 to 5. Well, here's one way to create those options for yourself. All right, well, we thank you for watching. You have a great day. We'll talk soon.